What is capital gains tax in Canada? Selling your high-performing stocks or property at a profit is a moment worth celebrating. But while you're enjoying the rewards of your investment, keep in mind that the tax man will come for his share in the form of capital gains tax. After more than a decade of working in investment banking, capital gains tax isn't just for finance gurus. It directly impacts your wallet. If you own a home, have shares, understanding capital gains tax means keeping more of your hard-earned money. In this video, we're going to cover what is capital gains tax in Canada and strategies on how to pay less tax when selling your assets. So let's start off with what is capital gains tax. Capital is an asset that you own, such as a stock, bond, ETF, mutual fund, or real estate property. If you sell an asset for more than it costs you, you have a capital gain. A capital gain, in simple words, is the profit you made from the sale. You pay tax on this profit, known as capital gains tax. Similarly, if you sell an asset for less than it cost you, you have a capital loss. Capital gains tax is only paid when the asset is sold and no longer in your possession. So if your shares or property increase in value, but you haven't sold it yet, you don't pay any tax on this. Now, how much capital gains tax do you pay? You pay tax on only half the gain. Many Canadians mistakenly believe that the entire gain is taxed at 50%. This is incorrect. Only 50% of the profit will be subject to tax, and this is called your taxable capital gain. This amount will be added to your taxable income and taxed at your marginal tax rate. Because only 50% of the gain is taxed, capital gains are taxed more favorably than other forms of income, such as employment income. To learn more about how your income is taxed, I will link videos here. So how do I calculate my capital gains tax? To calculate your capital gain or loss, you need to know the following three amounts. Number one, the proceeds from the sale. Number two, the adjusted cost base, which I will explain in a minute. Number three, any expenses incurred to sell your asset. Now, the formula to calculate your taxable capital gain is 50% times the proceeds from the sale minus the adjusted cost base minus expenses incurred to sell. Now, the adjusted cost base is a fancy word for how much it costs you to buy the asset, plus any expenses you incurred. For a property, your ACB is the price you bought it at, plus any expenses such as broker fees. For shares, you typically buy these at different points in time and at various prices. In that case, your ACB is a weighted average cost. So let's understand this with an example. In 2021, you bought 100 shares of Apple for $15 each, costing you $1,500. Your ACB per share is the total cost divided by the total number of shares, which is 1,500 divided by 100 shares, which is $15. In 2022, you purchased an additional 150 shares for $20 each, costing you $3,000. Your new ACB per share is the total cost, which is equal to 1,500 plus 3,000 divided by the total shares, which is 250, and this comes out at $18. Now, in 2023, you sold 200 shares at a price of $30 per share, and it cost you $10 in commissions to the broker to sell these shares. Now, going back to the three amounts you require, number one, your proceeds from the sale is 200 shares times $30, which is $6,000. Number two, your ACB is the ACB per share of $18 times 200 shares, which is $3,600. And number three, you had $10 in expenses to execute the transaction. Now, plugging these numbers into the taxable capital gain formula, this is equal to 50% times the proceeds from the sale, which is $6,000, minus the ACB, which is $3,600, minus expenses of $10 to give you $1,195 as your taxable capital gain. This $1,195 will be added to your taxable income and taxed at your marginal tax rate. Now, how do I report capital gains to the CRA? You report all your capital gains on Schedule 3 of your T1 tax return. For shares, the good news is that the financial institution will track your ACB and any capital gains and send you a tax slip so you can report it to the CRA. Now, how do I pay less capital gains tax? Number one, use capital losses. Tax loss harvesting is a fancy word used for offsetting loss-making investments against profitable investments to minimize your capital gains tax. If you sell your investments at a loss, you can offset this loss against other capital gains. Remember, you can offset different investments together. So for example, if you sold shares at a loss and sold an investment property at a profit, you can offset these together. If you have a capital loss, you can carry it back 3 years and carry it forward indefinitely. If you have both capital gains and capital losses in the same year, you must first apply the loss against any gains from that year and then apply it to previous years. You cannot offset a capital loss against other sources of income such as employment or business income. Capital losses can only be offset against capital gains. Number 2, keep track of qualifying expenses. Knowing which expenses to account for in calculating a capital gain can help you pay less tax. For example, renovations, transfer tax, legal fees can be deducted from the sale of your property to reduce your capital gains tax. Number 3, hold your investments in tax-sheltered accounts. Investments held inside tax-sheltered accounts, such as a TFSA or an RRSP, are not subject to capital gains tax. However, just remember it works both ways. You won't be able to offset any losses from these accounts against taxable capital gains. Number 4, claim the principal residence exemption. A common question that people ask is, what if I sold my house? Will I have to pay capital gains tax? If you sold your home at a nice profit, you can claim the principal residence exemption and not pay any tax. However, you still have to report the sale to the CRA on Schedule 3 of your tax return. If you didn't live in your home for the full duration of ownership, happen to rent part of it out like a basement for extra cash, or if you're self-employed and use part of it to run your business, please be aware that you may incur capital gains tax when you sell your home in the future on the rented or business use portion. The only way around this is if you meet all of the following 3 conditions. First, your rental or business use of the property is relatively small compared to its use as your home. And second, you do not make any permanent changes to the property to make it more suitable for rental or business use. And third, you do not deduct any tax depreciation on the rented or business use portion. I hope you found this helpful. In my upcoming video, I will explain how dividends are taxed in Canada. Let me know if you have any questions in the comments down below. Thank you for watching.